So what we're going to talk about today is just EOT. We're going to give a little bit of the background and then sort of talk through exactly how they're set up. Just bear in mind that the EOT structure is surprisingly straightforward. However, there are lots of options attached to it. So we're going to give the basic model, but actually it can become a lot more complex if you decide to use particular options. It is a positive thing that it can be fairly flexible, but obviously you can add a fair amount of complexity to it. So the first slide is just to give a little bit of background. The EOT as a concept appeared in the Finance Acts in 2014. This is very important because it's backed by legislation, and therefore it is a very secure structure, albeit that it could be changed at any particular point in time. But at the moment we think it's fairly secure. It also, because it's in legislation, the government like the structure, and therefore they've given rather generous tax relief both to the employees and to the selling shareholders. The actual employee ownership trust is a specialist form of employee benefit trust, but please don't be alarmed by sort of some of the bad stories you've heard in the last decade in terms of EBTs. This one, because it is governed quite tightly by legislation and the requirements there, this one is hasn't got any contentious parts to it. The John Lewis picture is there basically because what they were trying to do was model the EOT on John Lewis. The very big difference is that although John Lewis is owned by a trust, the trust is forbidden from actually selling John Lewis to a third party, whereas a normal employee ownership trust, the trust can sell the shares in the business when it's owned. So there is an opportunity for the trust to exit, and that would lead to the consideration for the sale of the shares being passed down to the employees as a whole. So since its inception, there's been about 350 sign-ups to the EOT, and these are some of the major companies which have done it, or the better known companies. So you got Wallace and Gromit there, so that's Aardman Animations. Richard Sounds, which has probably got the most notice, with Mr. Richard selling his business to the employees and then giving away a chunk of the money that he received as a bonus to all his employees. Riverford Organics, which is a large organic farm, very successfully EOT not long ago. And the group of people down at the bottom is a firm of architects. And actually it doesn't really matter which firm of architects it is, because it's just there just saying that this is a very popular form of structure now for architects. And I think last time I looked, it was something like 19 of the top 100 architect firms have now successfully transferred to the EOT structure. So if you're considering this structure, you are in very good hands. So the company sale. So what, in terms of trying to do an EOT or any exit, it's kind of objectives that owners might have is that, so one, they want to get a decent return for the efforts they've put in over the last God knows how many years. The sort of legacy part of leaving the business is also quite important to a lot of owners. So the whole idea of the EOT, it is a very gentle form of change of ownership. I describe it as, it can be that the business after the EOT transaction can be exactly the same as the business before it. You haven't got a third-party owner who's coming in who wants to change anything or rationalize anything. or add parts of businesses that they already own, like finance functions to the business. The business can continue to work in exactly the same way, with exactly the same management team and exactly the same management structures. It allows owners to exit in a timescale that they choose. So because the business after the transaction is the same as before, the owners, if they choose, and most do, can continue to run the business for as long as they wish, or they can exit immediately. It means you've got plenty of time to do your succession planning or build your new management team to take over the business. It avoids earnouts. So effectively, the price that is paid by an EOT is price at the transaction. There won't be any earnouts or any performance measures unless, of course, the owners decide to put something into the agreement. We think it minimises the risk and conflict. So that's a risk of, so I mean, effectively, I likened it to you are a business which is going through a change of ownership. I mean, that is a large change, even with an EOT. If you add to that, then it's a third party change, then you're bringing new people in with new ways of working, which adds to the risk of potentially that the change of ownership is not going to be particularly good for the business. Again, I'll go back to the point that the business is the same business after the transaction as it was before. So therefore, we think that an EOT transaction, of all the sort of change of ownership structures that you can do, probably minimises the risk of additional conflict. And of course, you don't have a third party to go through an extended period of negotiation over price. Because the business stays as it was before, we like to think that it looks after the employees, i.e. nobody's going to be, there's going to be no rationalisation, there's going to be no shared functions with other group companies of the group that you're joining. And quite importantly as well, and we'll get into more detail about this, it's a real opportunity to reward successors. So that's not just over the fact that they will become indirect shareholders via the trust, and therefore will get a share in the profits which would otherwise be paid to shareholders via dividends. But there's also other options of key staff becoming minority shareholders. So the sale alternatives, the sort of traditional way that you sell, all the ones down the side here. I mean, we think add risk basically because the business is very likely to need to change. And in fact, in some cases, the business might completely disappear. Some of these are more usual than others. So that, I mean, the closest to an EOT is a management buyout. The management buyout can be seen as having an advantage to an EOT, especially if you've got a management team who are expecting to take the equity of the business when owners retire. That will not be possible with an EOT structure, although there may be some opportunity to have minority interests for key staff. But and the liquidation is obviously if you get stuck in a business and you have no way of exiting via a sale, then frankly, and this does happen, that some businesses have to just sort of close the doors and liquidate the assets. So just getting into a bit more of the detail about what employee ownership trust and EOT transaction is. So effectively, these are all sort of requirements which are controlled by the legislation. So the first one is that the shareholders sell a controlling interest in their business to a trust. It has to have a controlling interest. We'll get into a bit more detail on that. The trust is the benefit of all employees, but if you meet all the requirements for an EOT, so you're an EOT compliant business, the sale of the business is exempt of capital gains tax for the sellers. That is only at the point when control passes. So it doesn't work if an owner wants to sell their business in particular tranches. So say they sold 60% of the business 1 year, 1 tax year, and then the following tax year they sold 40% of the business, they would only receive CGT EOT relief on the 60% when the control passed. And there was also income tax-free bonuses possible for employees. So these are the sort of detailed qualifying requirements. I'm just going to jump into the next slide actually, because it will all become clear when we sort of go through the detail of what these requirements actually mean. So requirements 1 and 2. So the EOT must operate for the benefit of all employees, and it must be on the same terms, which is where the equality comes from. So the same terms, what that means is, going down to the bottom, is that any benefit which is going to be passed on by the trust needs to be done in an objective way. I mean, effectively, the trust is only going to pass on benefits if it sells the business, because that will be the only reason that the trust would actually get funds which are due to the beneficiaries of the trust. So they sell the shares, so they get consideration, it comes into the trust. Tax will be paid on that, but whatever is left over then can be passed down to the employees. But it's got 3 there, but there's actually 4 ways in which the consideration can then be passed to the employees. So you can either split it equally, which is the one which is missing, or you can split it based on the remuneration for each employee, based on hours worked, or based on length of service. Those are the only 4 criteria which can be used. But you can mix and match them. So you can sort of say pay out half of it on equally, and then the other half on remuneration, or a quarter of it paid by the 4 different ways. Just jumping up to the middle, the employees, all employees means that all employees will become beneficiaries of the trust. There are 2 exceptions. One is that you can have a qualifying period for employees before they become beneficiaries, but that is limited to up to 1 year. But also, if you have shareholders who have owned more than 5% or do own more than 5% of the equity, they are known as participators, and they are not allowed to become beneficiaries of the trust. So basically, all former owners cannot become beneficiaries of the trust, so you don't get another chance, even if you're still working in the business post-transaction. And you might want to be careful if you want to give new minority interests to key employees that you stay below the 5%, because then they'll get the benefit of the shares that they own, but also get the benefit of being a beneficiary of the trust. The same terms concept is important because it is also used when you're paying a tax-free bonus, which is clearly going to be the most times that you use the same terms. That can be seen as quite limiting, but having the ability to pay tax-free bonus does not prevent you from paying a purely discretionary bonus to your key performers or your biggest performance in the business. So you can pay out bonuses as normal with tax paid, or if you follow the same terms, you can also pay out tax-free bonuses. There's a bit more left on this, but you don't get exemption to national insurance. So requirements 3 and 4. Fairly obviously, the company must be a trading company. So a company that is set up purely to be an investment company is not able to do an EOT. And control must pass, and the definition of control passing is all of these criteria must come into place. So there must be more than 50% of all ordinary shares owned by the trust. The trust must have voting rights, more than 50% of the voting rights. It must have more than 50% rights to profits available for distribution, and it must have the right to over 50% of assets on winding up. In terms of the profits being available for distribution, that would mean if a dividend is declared, the trust would have the right to over 50%. However, virtually all EOTs that have been set up, with only a few exceptions, waive their right to receiving dividends. And the reason being is that if you paid a dividend into a trust, it would be very tax inefficient because you'd be doing it in order to distribute it to the beneficiaries. The trust would have to pay tax on the dividends coming into the trust, and then the employees would have to pay tax as it's distributed down to them. It would be much more sensible to pay a bonus, because then you'd only have to pay tax once or not at all if you're paying a tax-free bonus. I've mentioned the one at the bottom in that the CGT relief is only available in the year in which control pass. This is very important if you want to sell different tranches. It does mean that most businesses that do an EOT, the owners do actually sell 100%. It's something like 80% of all businesses going through the EOT transaction. 100% of the equity is sold. And then there's a slightly stranger requirement is called the limited participation requirement. And effectively, this is to prevent tax avoidance by family-owned companies where the business is sold to a trust. The owners take advantage of the tax relief, but actually the family still control the trust because they're all beneficiaries of the business. So what it's saying, just cutting through the sort of the calculation, it means that of the entire workforce, less than 40% or less of the employees can be participators or family members of participators. So if you're 10 employees, you can only have 4 owners who own more than 5% in order to be eligible to do an EOT transaction. It's worth mentioning in this sort of times that there is some flexibility on this requirement. So if circumstances dictate, if you do an EOT transaction or are planning to do an EOT transaction and circumstances dictate that you lose staff and you drop below this threshold, if it's for reasons beyond your control, i.e. COVID, and you move back into a compliant situation within 6 months, then it doesn't matter. And this requirement, most of the requirements are permanent, but this requirement is time constrained. So it's 12 months before the transaction and then until the end of the tax year following the transaction, after which point you can forget about it. Just very quickly, just comparing EOT relief with entrepreneurs relief. For entrepreneurs relief, you've got to own more than 5%, unless you've got an EMI option, but we won't go into that detail. And you have to own it for more than 2 years. There is no such requirements for EOT. Literally, you could get the shares the day before and still get your EOT relief if you sell them to an EOT. So for entrepreneurs relief, you must be an employee. You don't need to be for a EOT, but you need to sell more than a controlling interest in the business. Tax relief for entrepreneurs relief is 10%, but only up to £1 million lifetime allowance or lifetime limit, whereas CGT there is no limit. It's zero regardless of how much you're selling your business for. And conditions post sales for entrepreneur relief, well, there aren't any, but basically a EOT owned business needs to stay compliant with all regulations. Otherwise, there is a potential clawback of tax, but that will only matter to the vendor if the business becomes non-compliant within the tax year in which the transaction took place or the following tax year, at which point it just adds to the tax liability that the trust would need to pay. So you're selling your business to a trust, which will be newly created for the purposes of selling the business. And so there's a question about how the shareholders are actually going to be paid. So this is the sort of how you would actually fund the transaction. So the top two are very normal. In fact, the top one is a spectacularly good benefit, given that you can actually use this as a capital payment and get 100% CGT relief. So you can take free cash on the balance sheet, i.e. cash which is not needed for the operational running of the business, and distribute that immediately the EOT transaction taking place, and there will be no CGT to pay on that. The rest of the transactions, and actually the most popular way in which EOTs are funding, is via vendor loan, which will be paid off by the trading company making contributions over a period of time out of the profits being generated by the business. We like to see that a EOT transaction can be completely paid off within sort of 5 years or so. We think that's kind of a comfortable period. Sometimes they take longer if there's been a slight downturn in business. Sometimes they take less time if the business is sort of flying ahead. Third-party loans are possible for EOT transactions. You need to be slightly careful in that because you'll potentially be borrowing a lot of money, and you need to find a bank which will be prepared to lend the funds to the trust rather than the trading company. Otherwise, you're potentially going to damage your balance sheet and your credit rating. But they work essentially the same way. Third-party loans are good for vendors because they get their money quicker, because their funds come into their business immediately. Arguably not so good for the business because a third-party lender is probably not going to be so understanding as somebody as a business with a vendor loan. Private equity investments are pretty rare, but do happen on occasion for very enlightened private equity firms. So now we're going to get into the nitty-gritty of how these transactions take place. So first of all, business has obviously decided it's going to do an EOT transaction. So the company will establish a trust in order to do the transaction. A fair value will be agreed. It will be agreed between the shareholders, the trustee of the trust, and the company. The limit is that a trustee cannot pay what is more than a fair value for the business, and that's usually decided by a valuation of the business. Payment terms will be set up, and everything will be agreed between the shareholders and the trustee and the company. At that point, the shares can be sold to the EOT, probably with an SPA, but we've seen transactions being done where actually there's very little more than a stock transfer form being done. Effectively, the transaction is done on not much more than a handshake, not a route that RM2 would recommend. There's just too much risk there. Much better to have legally binding paperwork. So the shares have been sold to the trust. The trust writes a very large IOU to the shareholders, and then the company will make contributions to the trust, which will then be sent on to the shareholders, and this will take place over a number of years. So you'll get your initial payment, which will be money which is already in the business, and then it's down to cash being generated over the next number of years by the company. The company, it is like dividends, but it is not dividends, and you don't call them dividends because if you call them dividends, you'd have to pay tax on them. These are effectively gifts from the company to the trust. There's no tax paid going into the trust, and there's no tax paid going to the shareholders. The reality is your trust will almost certainly not have a bank account, so actually the transfer will take directly from the company to the shareholders, and your accountants will basically just do the relevant entries to show that the loans are being repaid. To give the shareholders, obviously the shareholders have legally sold their shares to the trust. They are completely reliant on the company making contributions to the trust. And this might be quite worrying if you're a shareholder who is actually planning to exit. Your comfort is that you will have a legally binding sale agreement and a loan agreement. And you can also give yourself a charge over the company's assets. You cannot have a charge over the company's equity, because one thing you cannot do as per the legislation is create a route where the selling shareholders can take back control of the equity of the company. So this is the next best thing. So where we put, so we're now going into post-transaction, and we're making the sort of point that, so now the company is owned by a compliant trust, and it now can pay bonuses tax-free to employees. But we say when circumstances allow, because the reality is when these transactions take place, shareholders need to be paid, and that can be quite a significant drain on the funds being generated by the companies. I mean, we tell our clients that if you have a culture of paying bonuses, it's almost certain the right thing to continue to pay those bonuses. But until the debt is paid off, or mostly paid off, you may not want to increase the level of bonuses which are being paid to employees. So in terms of employees, often when they're involved in businesses doing an EOT transaction, financially they may not see much difference until the vendor debt is actually paid off. But this is a very important part, is that your key staff, or actually on some of our clients this has been fairly widespread, that employees can take direct shares in the company. We will get into a lot more detail on this, because this is what I consider to be an absolutely fantastic opportunity, and I would say the majority of our clients take advantage of it. So just to highlight tax-free bonuses, so the company which has got a compliant EOT ownership, they are able to pay tax-free bonuses up to £3,600 per employee per annum. That limit comes into play immediately the transaction takes place. You do not have to earn it. So say you did a transaction in March, you could immediately pay a full £3,600 tax-free bonus to all your employees, and then when you go into the next tax year in April, you could pay another £3,600. You don't, it's not prorated depending on where on the tax year that the transaction takes place. Important part is that if you're going to pay a tax-free bonus, you need to pay it on the same terms. So it can't be a discretionary bonus. It needs to be calculated in an objective way. Remember, it's remuneration, length of service, hours worked, or you could just split it equally. Equally, you get income tax relief. You do not get national insurance relief, so you still got to pay employers and employee national insurance. These payments are paid by the company, not by the trust. They are paid via PAYE, and pretty much all software, and we're not aware of any which can't handle this. All software is able to handle EOT relief via bonuses. So just getting into a little bit more, we've spoken about the opportunity to give key employees a minority share interest. You might give it directly via shares, or you might do it through a tax efficient scheme like an EMI share option. They pretty much work the same way. Effectively, what happens, effectively what you can do is you can sell shares or give options with very low exercise prices to your staff. And the reason being is, say you've got a company which is worth £10 million. The value is created from an enterprise value of 9.5 million and cash of 500,000. Transaction takes place, cash is paid out of 500,000. There is a debt of 9.5, which the company will write a guarantee saying, actually, we're going to pay this debt. So a valuer has looked at this business and said, enterprise value and cash means this business is worth £10 million. The day after the transaction, the same valuer would come in and say, well, the cash has disappeared, and now the business has got a debt which is kind of obliged to pay. Therefore, this business is not worth very much at all. And this is where you can actually sell shares at a much reduced value without a benefit in kind tax hit to the employees. It sounds very negative in terms of the valuation of the business goes down, but it gives a fantastic opportunity, which I would say a large percentage of companies that do these EOT transactions take advantage of. And that way you can also incentivize your key management, as well as them, if they stay below the 5% shareholding, they can have their minority shares, which they can take a direct benefit from them and they can receive dividends on. But also, if the business is eventually sold, they can sell their minority interest shares, but they can also take another bite from the cherry by being distributed the proceeds of the sale via the EOT. If they can have shares over 5%, but obviously they won't be beneficiaries of the trust anymore. So I'm just going to go into, in fact, I'm going to click all these. I'll make sure I don't go too far. Yeah, so we're getting towards the end of the webinar, and this is just a summary of, we see it on the benefits of doing the EOT. One thing which isn't here is, and from experience of being parts of the team doing third-party sales, I would say possibly the biggest benefit of doing an EOT transaction is actually you don't have to sell the business to a third party, and you don't have to sort of distract yourself going through prolonged negotiations with a third party who ultimately might walk away before the transaction finishes. It is a massive benefit doing that. EOTs, although you have rules that you need to follow, essentially they are seller controlled transactions. You can't abuse the situation because you can only sell at a fair value, and ultimately if the business is not worth the amount that you sell at, you won't get your money anyway, because you're reliant on that business being able to generate the profits in order for you to have your debt repaid. But there is a massive benefit in just not having to sell via a third party. So the rest of the stuff is just, hopefully what we've already mentioned, in that owners can sell their business at a full value as long as it's a fair value. They can exit at a pace that suits them and suits the business. They do not have to pay any CGT relief. there's, I would say, low execution risk. There's virtually no execution risk. The biggest execution risk is the vendors just change their mind and don't want to do it anymore. Because if you can do an EOT and you go along the path, basically you will finish it unless literally you change your mind. You don't have to go into a big negotiation with a potential seller. You don't have to give sensitive information to competitors. The company stays pretty much the same as it was previously, so stays independently. We sort of talk about our Wallace and Gromit when we're talking about this, because the owners of Wallace and Gromit, they stated that one of the major reasons that they did an EOT is because they didn't have to sell to a third party, and therefore see all the animation being moved overseas or the company just being broken up. Because the company stays as it is, the founders have their legacy. And a very important part of this transaction is that you can gain advanced clearance on the structure of the transaction, not the sale price, but the structure of the transaction from HMRC. And employees, especially when the debt is paid off, can benefit financially when there's no longer shareholders or as many shareholders to take the profits of the business. And that's before we even get into the softer things about actually you can work on getting higher employee engagement, because actually employees should be able to see that the profits, the contribution that they're making to the business is generating the profit, which ultimately will come down to them as the indirect owners of the business. And that is a whistle-stop tour of EOT transactions. And I'm just looking at the time and it's taken about 40 minutes, so that's not bad. As I said, I just mentioned again, if you want to take any questions offline or you just want to contact RM2, my email address is below, and I'd welcome any questions being passed over. The slides are available if you'd like to get a copy, and this webinar will appear in the next few days on our website and on YouTube. I'm just going to click into questions just to see. And okay, I have some questions which are incredibly difficult to read. So I've just been on slides are going to say, well, send me an email asking for the slides and we will send you a copy. What is different or specific about architect practices that makes EOT more appropriate for them? I would say, I mean, this is a personal opinion, I would say that it's becoming the sort of usual practice of architects firms being partnerships. I mean, this is partnerships in general, is becoming a model which is becoming more and more difficult to work. The whole idea of new partners coming into a partnership and paying in money in order to allow the existing partners to retire, I think is becoming a concept which is becoming more and more difficult for new partners to accept. And also we've come across partnerships where literally the value of the business is just so high that actually nobody can afford to be a new partner, and it's just becoming more and more difficult. And I think that's one of the reasons why architects has found this such a good model for them to sort of move into, because you kind of get same sort of group ownership that architects like, but without you know, people having to fork out a lot of their own money. I mean, actually, this is makes another point, is that EOT transactions, none of the risk of failure of the EOT transaction falls down to the employees or to the next generation of directors. All the risk lies with the vendors, which is actually a reason why most vendors, when they do these transactions, plan to stay within the business for a period of time, often until all the vendor debt is paid, and that's their approach. So hopefully that answers the question. I think that's kind of right. We've done a couple of architects, and that's been the sort of issue that they've had. Oh yes, so a very good point has just been made. It says, does an EOT create a better culture of high performance in employees, leading to improved profitability? The evidence suggests that yes, it does. Although I would say that I know studies have been done in the UK, but remember that the EOT model has only been around for 6 years in the UK. So I would say actually studies which have been in the UK are probably a little bit early. However, this model is similar to a model which is in the US, which is far more established and has been around for a lot longer. And studies have been done where they found that employee-owned businesses in the US do tend to have much more higher engagement and do have higher profitability, and really interestingly are far more robust to downturns than normal businesses. So yes, that is definitely worth mentioning. I did sort of mention it at the end. Yes, I have covered mostly the transactional side of EOTs, but it shouldn't be forgotten that actually this should turn into a good concept for the employees to become more engaged. In fact, there's a lot of businesses, when they do these transactions, do spend a lot of time preparing their business to go into employee ownership, where they sort of set up, they have trustees where you have employee representatives, even have employee representatives on boards, and they have employee councils. I would say that only works when you get to a business of a certain size. A lot of our clients are really quite small, and it's, frankly, it's not really necessary to sort of start changing the culture and the structure of the management structure of the business. I mean, the whole thing about EOTs is that you can actually do whatever you want. You can have a business which does an EOT and actually doesn't really change post EOT, and maybe won't change until the debt is paid off, and that's fine. And I think that's a very safe way of doing a change of ownership. Or you could go whole hog and attempt to change the culture. It's the option is there. I mean, as I mentioned, there is a fair amount of flexibility in terms of what you can do with EOTs, but a very good point. I'm going to take one more question. The question is, do you receive any objection with partial sales, as normally HMRC tend not to like partial exit when considering alternatives? That's an interesting one. The simple answer is no. We have not had any objections to partial exits from HMRC when we have done them. However, I have heard of objections to other transactions where partial exits take place, but I really don't know enough detail about why those objections are taken. And it's probably risky for me to try and sort of guess at what those issues are. So the answer to that is possibly, but we haven't come across it personally. but we think that other advisors have. I've noticed that I've kind of hit my 45 minutes. What I'm planning to do is take all the questions that you've answered. So if I've not managed to get through your question yet, what we will do is take all the questions together. We'll write answers, including the ones that we've already answered, and then email to all participators. So thank you very much for joining me. My name is Richard Cowley. The company is RM2. We have done approximately 45 of these transactions. We'd like to think that we know what we're talking about, and we'd like to think that we know all the pitfalls that potentially people can fall into, and I'm afraid some people do. So if you'd like further information, or you're considering taking your own business through an EOT, please feel free to get in touch, and I'd be happy to have an offline conversation with you. Thank you very much for joining, and I hope you found this useful.